stocks are riskier. Stocks should have a bigger yield than bonds. And right now, the S&P 500 has the same yield as the 10-year Treasury. The last time this happened was back in 1999, 2000, before the lost decade.
Hello, everyone, and welcome to Rise Up, our weekly touch base on all the stories that are hitting the news, how to think about it, how to react. Unfortunately, Terry's not with us today. She's in a family work situation that she's going to be out for. She'll be back next week. Thoughts with her. We do have two great guests with us. We have Kevin, who's both a CFA and a CFP, and Chris, who's a CFA and works with clients directly. We're thrilled to have them both with us. We did have a great set of stories that we were going to kick off our big three, but one story kind of took the headlines in the last hour and a half or so, and that is the interesting discussion that's happening between the president and I don't know if he's the current or the former head of Tosh, but certainly the excitement between the two of them has picked up. As you know, on this show, we try to stay away from politics, but sometimes it's unavoidable as we help you with your investing decisions. And as you know, we bring in a CFP perspective, a financial planning perspective, alongside the insights on investing. Let's talk a little bit about what's happened today. And obviously, it's been an unusual set of interchanges. I don't think anyone's super surprised that two people with reasonably healthy egos have found a way on the opposite side. Just so those of you that are not caught up are aware what has been transpiring in the last few hours. As many of you have seen, when Elon Musk stepped down, he was not overly thrilled with the big, beautiful bill that has passed through Congress. He was making some pretty strong comments about the actual bill, really not supporting it. In fact, not in love with the amount of deficit spending that was implied by the new bill. And today the president was asked about it and made some barbed comments about Elon Musk. Elon Musk then went onto the social media platform that he owns, X, and made some comments. And then Donald Trump went onto his media platform and made his own set of comments, all of which have been escalating to the point where there's discussions of stopping some of the work that's being done by the government, by Elon Musk, and the same thing from the president suggesting they stop using it. And all of that really had bad impact on Tesla stock, which fell around 14-15% pre-market. It's down another few percent post-market. Hey, Kevin, first, any thoughts on what's transpiring right now between the president and Elon Musk?
It's sad, Joe. Have you seen the fake magazine cover yet?
No.
Trump and Elon divorce shocker. Why they split? It's like a celebrity divorce story, like something you'd see in a tabloid or Us Weekly. So if anything, it's certainly entertainment for the people. Like you said, a lot of ego, and you have a media that's itching to fan the flames, I think, in really any direction possible. Thinking about this, in my opinion, I would say that Elon Musk, in my opinion, certainly has more to lose. Tesla receives subsidies from the government. Trump has shown that he's not shy about a vendetta. Look what's happening with Harvard. So yeah, I think this is probably much to do about nothing. I think that Elon's original comments were really aimed more at Congress for porking up the bill than anything else. But nonetheless, here it is, and it's the number one story of the week.
And I would say, we want to be thoughtful about the fact that, when I was at grad school, I remember one thing that was really interesting, which is you can't beat the government because they make the laws. And at the end of the day, this is not really good for anybody. It's not good for the president. It's not good for Elon Musk, and certainly not for his companies. And so the question is, does it de-escalate relatively quickly? But if it doesn't, what does it mean for Tesla stock? Chris, I know you work with individual clients. Let's talk generally about Tesla. And then what do you do if you own Tesla? Because obviously the government has many ways to put impediments to the success of Tesla. I'm struck with one obvious question, which is, I think Elon Musk alienated a lot of the traditional Tesla buyers with his position and how he dealt with the Doge cuts that they put through. A lot of the what I'll call the left leaning or coastal buyers of Teslas. And now, by taking on the president, I suspect he's not making great fans of the MAGA nation who are buyers of his Teslas. So, what does this mean for Tesla stock if you're an owner, Chris?
Yeah, I would think I would get back to Kevin's point is that it's probably not great for Elon and Tesla right now. I do hope that cooler heads prevail, and I think they will. In fact, the government needs Tesla, especially on the SpaceX side. They're doing a lot of work with the federal government, and I think if you saw one of Elon's posts, he said he was going to decommission that right away. So they're both going at different parts of the market that are important to them. So I think over time, cooler heads will prevail. But if you own Tesla stock, I certainly wouldn't sell it on this news. There still is some merits to owning Tesla at some point. And as we always say to clients, you want to make sure what your position size is. Make it's not an oversized position. We certainly wouldn't recommend having a large position in Tesla. There's a lot of risk there still. The cars have slowed down in sales. There's a lot of expectations on the robo-taxis that he continues to promise. So there's a lot baked into the stock that needs to come through. So not to sell it, but certainly make sure you have the right position size.
And obviously, I think we've had continuing declining sales of Teslas in Europe, which is not great. The numbers have not been good here in the US either. But today, Tesla stock is really about robotics on one hand and automated driving. And obviously, the launch was meant to be in Austin, I think this week or next week. But it's quite a long runway before those businesses make money, which means that the further out in the earnings period you look out, the more impact it makes to have any risk to the execution of that. It'd be very easy for the government to suddenly add some new regulation for self-driving vehicles that suddenly makes it that it's a year or 2 years away. So just to get a little bit more specific, Chris, on what you would advise if you own Tesla, you said two things that I think are interesting. One, do you sell it or not? Your advice is to hold on. Number two, what do you do if it is an oversized position? Obviously, the stock's done immensely well over the course of the last 5 years. And so what do you do if you've been part of that big run, that the quintupling that's happened in the stock, since years ago?
Yeah, I mean, if you have an oversized position, there's no problem with taking some gains in the stock, or you could certainly use options if that's part of the portfolio.
And using options means doing what?
Well, if you're trying to protect the position, you're going to sell some calls, correct? So that's what you want to do in the portfolio.
Okay, so just to reiterate, you can sell the upside. You get a yield on that. And if the stock goes up beyond that, people would buy it from you. So you could say, hey, if it goes up 10% or more from here, you would get paid for selling that, right? And it's called a covered call. You would have the stock. If it gets called from you, you'd deliver that stock and in effect have sold it at a premium to where you are today. Plus you would have kept the option value, which is not small in a stock as volatile as Tesla.
Yeah, and I would also say it's okay to sell some of the stock as well if you have an oversized position, just to mitigate the risk. The likelihood is it's not going to go down much, but it's okay to take capital gains in some of these scenarios.
Kevin, let's just talk about that for a second, because just before we get to topic 2, I do see very often a lack of desire to sell your winners from individuals, especially if it's a position that they've become a fan of. And so when do you know it's time? Like, is it valuation? Is it the weight of the position? Like, what kinds of things should you think about when it's like, hey, I should lighten up this position?
The first thing I would say is you never know. No one knows anything. I think that you hit on a couple. And the size of the position in the portfolio is certainly probably one of the biggest drivers. Your tax implications, a big driver. So if someone can hold a position and have it go long term for capital gains, that can make a big difference depending on your tax bracket. But let's face it, I mean, this is a stock that in the last 2 years, even like you go back the last 3-4 years, the trading range is really between 100 and 500. And right now it's at 285 or whatever. It's right in the middle. These investors are used to a wild ride, right? I mean, there's been many stories like this. I hate to say with the stock, and I think it has a lot to do with their CEO. So it's certainly no stranger to extreme volatility. Well, one more thing on the options too. Um, you can always buy puts, you can buy protection on the downside, but one of the biggest inputs for any of these options is volatility, and it just makes buying the protection on the downside very expensive. But it might actually be a decent thing for what Chris and you were talking about, selling the calls. And when you're a seller of these options, and there's a lot of volatility, which certainly is in this stock, you're going to get paid on that option that you're selling. So you'll probably get some pretty big premium there.
And let's go to our second story here. The economic slowdown. We had, I think it was 4 straight days with the Dow doing very well. The S&P not coming far away from crossing into old high territory, which was really great. And then we had a pretty disappointing jobs report. I think we came in with 37,000 instead of the 110,000 that were expected. We've also seen the 10-year bond, which is a good proxy for the economy. I think we were almost at 5%. We're now back down to under 4.4%. So, Chris, do you think we're heading into a slowdown? How do you read what we're seeing from the interest rates and from, frankly, the stock market as well?
Yeah, I think when you look at the economic data that's come out over the last couple of weeks, it's been mixed. As you mentioned, the job report, the ADP report, was a little bit weaker than expected. The initial jobless claims this week were a little bit elevated. The beige book that came out this week wasn't as bad as people said. You had 4 areas of the regions be a little bit negative. 3 were unchanged, and 5 saw a little bit of growth. So I think you're in our investment committee, we talk about this all the time. You're in this sort of era where there's just as much chance of the market going up as there is going down. And to call a slowdown right now, I think, is a little bit premature. You're certainly seeing some weakness, but to say that we're going to go into a recession right now, I think is a little bit too early to make that call. Many people have been making that call since the Fed rose rates a long time ago that we were going to go into a recession, and we didn't. So I just be careful. We are seeing some mixed signs, but overall, I think it's still yet to be determined.
I'm a little concerned, Kevin, with valuations, where they are today. We're back to very, very frothy valuations on the S&P 500, in large part to the Magnificent Seven, as they're called. But how do you think about what people should do if there is a slowdown coming? What should they do with their portfolios? You manage billions and billions of dollars for people. You meet with individuals every day. So how would you counsel them? What should they do going into what could be a recession or not? Like, what do you think you do with valuations where they are?
Yeah. So look, when you're investing, the battle should be fought ahead of time. You should have your portfolio should be set up in such a way that it's not going to require tinkering or modifications in the heat of things. So considering that, and you look at the world where valuations are. I mean, the high valuations. We'll probably get into this a little bit, but the high valuations really reside in large cap U.S. stocks. And if you look at, everyone always talks about the PE ratio. If you flip the PE ratio on its head, you get the earnings yield, and if you look at the earnings yield, it's like same as a 10-year Treasury at 4.5%.
Okay, so just to be clear, earnings yield is you take your earnings and you divide it by the price, and you get what is the equivalent of what are you getting in earnings for each dollar you invest in companies, not in dividends. It's kind of like a dividend yield, but you're taking the earnings of these companies.
It makes it easy to compare stocks to bonds, and when you do this, stocks are riskier. Stocks should have a bigger yield than bonds, and right now the S&P 500 has the same yield as the 10-year Treasury. The last time this happened was back in 1999, 2000, before the lost decade. We're not calling for another lost decade, but the bottom line is, large cap U.S. is the only area of the market, really across the whole world, that's experiencing this. And so, getting back to PE, you look at the S&P 500. It's got a forward PE of 21, almost 22 times. The average PE for the S&P 500 is still higher than the rest of the world, but it's at about 16. So you're talking about being about a third over your average valuation. That's a big premium right now in valuation. And you look at that compared to small U.S. stocks or compared to developed foreign or emerging markets or bonds, and you don't see that. You see kind of everything else really kind of right around historical norms. And so it's a strange world where we're talking about overvaluations, but in reality, the average stock out there is really probably right where it should be. I mean, if you look at small cap stocks, you look at a lot of the foreign stocks, they haven't set new highs since 2021. So it's really been a concentrated market in large cap. So getting back to what clients should do, I mean, let's face it, the large US, if you had exposure, is probably a really big part of your portfolio right now. And it might make sense to trim it back to what your original allocation was, or or use an advisor to help determine what a fair allocation is. Maybe consider moving to some other areas of the market.
And let's get to our third topic of the day, because it speaks to exactly this. Where are there areas of opportunity? You've talked a little bit about international. I think the German DAX is up well in the high teens compared to the S&P, which is basically flat for the year. So there's quite a big spread already this year. Any other, Chris, areas of opportunity that you would say to people, hey, if I had fresh money to put to work, here's where I think I would consider being for the next couple of years?
Yeah, I'll just dovetail on what Kevin said. When you look at valuations, especially in the S&P 500, as he said, 22 times. If you take out the Mag 7, it's around 19 times. So still elevated from historical levels. But when you're looking at the U.S. areas, there are opportunities, healthcare stocks, energy stocks, some areas of the consumer staples. Now, these areas haven't done as well, so we're not saying to pile into those areas right now. You probably want to see a little momentum, especially in energy and healthcare, before you start to put that money to work. But there is opportunity there. And then outside of the U.S., as Kevin said, international markets and emerging markets have had really 10 plus years of underperformance. This year, they're starting to show, again, why diversification matters. So those areas would be opportunities as well. And bonds, as we've said all along, bonds are much more attractive today than they were 3 or 4 years ago.
I mean, interestingly enough, because so many people index invest now, valuations and concentration, as most people know, when you buy an index, it's cap weighted, which means that more money goes to the big companies than the smaller companies. You can buy an equal weighted S&P, which tilts your average portfolio down, diversifies you into all 500 stocks equally. But that has not been a winning strategy because most of the money still flows into the cap-weighted S&P 500. So I guess you don't want to try beat the markets. It's hard to do, but you can make some decisions about valuation. And if you think about, Kevin, you were talking about 99 and 2000. I remember that period well. The truth is that all of the nifty 50, like the Cisco's and all the internet stocks that burst, the value stocks did really, really well for the next year or two, actually were positive. But if you had an index fund, you got hit so hard by the collapse of those big stocks that if you had an equally weighted stock portfolio, it did much better than the S&P 500 traditional index. So one idea I'd have is if you're worried about valuations, you can own the index without owning everyone's index, which is the S&P, the SPY. So you can buy an equally weighted S&P. It does tilt your portfolio down. And if the large cap growth stocks continue to outperform, which they've been doing for a long time now, then you're not going to participate to the same degree. But that would be true if there was a correction on the way down. Any thoughts on that, Kevin?
Yeah, I think that's a really great point. I mean, the index effect is real. Every dollar put into an index fund just goes into every position in there, and it rewards the bigger companies. So you have that natural tailwind every couple of weeks of everyone's 401k getting put in there and all the pension funds and whatnot. So, but I totally agree. I remember after back in 2001, 2002 with the recessions and 9/11 and WorldCom and Enron. It was a very tough time, but you're right. Value stocks did really well. But then on the other side of that, it was emerging markets. If you remember, emerging markets and then small cap stocks, they went on a tear. I remember talking to clients and they would say, why would you ever buy large U.S. companies? There's just no growth in large U.S. companies.
Right.
Everyone knows you need to invest in the emerging markets. And I would say, we need large U.S. And here we are. And I'm saying, we need emerging markets. And so it's the same thing, only in reverse.
Well, our big topic today is Ask Us Anything. And we've had a ton of questions from the last few sessions. So let's start with, I'm going to read this one because I want to make sure I do it accurately. From Randolph with 2 H's, 8005, who reacted to our conversation last week about buying the dip versus selling. They pointed out that we talked about the dangers of trying to time the market. I want to know, if you're sitting with without a lot of cash, how do you get invested? And the second question, should they rotate their asset classes instead? So, Kevin, the question is, you don't have a lot of cash, you're invested already, and the market has, obviously, the dip left us a month ago. But if you were in that situation, what do you do if you don't have a lot of cash?
Sure. So I'm going to make a couple assumptions here that this is a long-term portfolio,
Yes, yeah.
and also that we're not going on margin, which we're not recommending at all for speculation. So, I mean, look. So take stocks and bonds, right? If stocks are at all-time highs and bonds are yielding 5%, then it probably makes sense to take some money out of your stocks that have done really well and put it into some bonds. And also, same thing the other way. I mean, you go back into April, if stocks go into a correction territory and bonds rally, which means the yields go down, there's a flight to safety. And that's probably a good time to maybe take some money out of fixed income and put it back into
And
stocks.
just to be clear, Kevin, you're not recommending you time the market. You're just saying, look, if your allocation, if you originally were at 50-50 just 6 weeks ago, and the S&P 500 has gone up 24%, your 50% in equity is now maybe, and assuming the bond market has been flat, your 50% in equity is now as much as 62% versus 34%, 38% in fixed income. So your allocation by itself is now much riskier. You've enjoyed the ride. And so the easy move to do is to reshift your portfolio away from the asset class that has done poorly or from the thing that's done well and go to the thing that's done poorly. In a dip, the reverse would be true. The S&P 500 had fallen 20%, which means that your 50% allocation in stocks was now 40%, which means you had 60% in bonds. And you should probably at the dip, instead of putting cash to work, you just shift back to your target allocation. And that's a very non-timing way to be disciplined. A good advisor would automatically do this for you, rebalance your portfolios. But that's a good way to think about it, right?
It's the oldest trick in the book, Joe. It's called rebalancing, and it goes hand in hand with having diversification. So it's just that. It's just simply rebalancing, just like you said. And by the way, nice job with the quick math there. But look, honestly, rebalancing works best at market extremes, right? Because markets can trend for a long time and things can go for a long time. But when you get to these extreme moves or these very quick moves, like Joe was just saying, it could really be presenting an investor with a good opportunity to rebalance back to a target allocation. So remember what your plan is, remember what the target is, and don't be shy to get back to it when the portfolio skews too far from what was your original.
And Chris, if you haven't rebalanced, you now are in a position where you have far more risk than you originally intended because your stocks have done so well. You now have a misallocation that if you were to come today brand new and put that money to work, you would not put 65, 70% of your money in stocks if you're retired. And that could be where you are if you were originally at 50-50 and the stock market's gone up a lot, and vice versa. So I know that's one of the cases for why you want to be diversified in non-correlated assets, which means they don't move together. And that's true even within equities, right? Like that's why if you have international and US large cap and small cap, you can make the same kinds of adjustments within the risk assets, right?
Yeah, I mean, I didn't say this on my last answer, but yeah, when you look at small cap and mid cap stocks in general, Kevin talked about it earlier, but it would be a great time to take some large cap exposure and move it into small and mid cap stocks. They've been really held back by the higher interest rate environment that we've been in recently. So those stocks, the time will come when small cap stocks will outperform, and this is a good time to start taking some profits from your large cap and move it into small and mid cap stocks for sure.
Well, let's go to Bognerman19. I love these names. I want to make sure I get it right. Who reacted to our drumbeat talking about the specific subject about having a balanced portfolio to protect your wealth. He says he would love to have a balanced portfolio, but his 401k plan does not have many choices. It has commodities, no gold, no dividend funds, no Bitcoin, only US stocks, international stocks, bonds, and money market. This is less frequently the case now. Like most 401k plans tend to have quite a few choices. That's not the case here. What should he do, Chris?
Well, first off, he should certainly diversify on the few areas that he has in the plan. So to make sure you're invested in U.S. stocks, international stocks, and bonds, diversify that way. Other things, certainly, I'm sure he's already called his HR department, but you could call and see if the 401k provider could allow other opportunities on the platform. That's an option.
Sometimes you have the ability to have a self-directed outside the plan choice, right?
Sometimes you can, depending on the platform.
Doesn't seem like this plan probably does. It's not very sophisticated.
Yeah, and then I would say if you want to diversify, you can also start to build up wealth outside of your 401k and open a brokerage account and put in some areas of that you don't have, whether it's small cap stocks or dividend paying stocks that you don't have access to in your 401k plan.
And this is something we call householding, right? Like, okay, I have these choices in my 401k, but I have this outside money, and I can basically look at my entire household and make investments that put the whole amount, understanding obviously the 401k is not liquid till you retire, but it allows you to think about your entire portfolio rather than just the piece that's inside the 401k.
Yeah, that's 100%. Just look at it as one portfolio and then put those areas that you don't have access to in the 401k into another account to diversify even further.
Kevin, I'm a CFA, not a CFP, but I have to ask the question. When can you actually roll your 401k into an IRA? Because I know when you leave a company, when I left Goldman Sachs, I was able to take my 401k, roll it into an IRA, which gives you all the choices in the world, depending on the custodian you're at. But can you do it while you're an employee at a firm?
You can. It's called an in-service rollover. It would depend on the plan, I believe. Some plans you can't do it, but I think a lot of them are age 55 where you can roll them into it.
So one answer here is if he's older than 55, assuming it's a he, could be a lady, although Bogner man, who knows? He could potentially have the choice of rolling it into an IRA, putting that with one of the big custodians, and then you have the universe of all the ETFs and choices inside of that universe. There's a small IRA fee. If it's big enough, it's not even a material amount, right?
Right. In fact, it might even there could even be lower expenses because a rollover IRA is probably got very little cost, and then if you're using exchange traded funds or things like that, there's going to be, I would think, very low expense ratios.
And lower costs than they probably have inside the plan in the 401k. These plans that have very few choices often have very expensive choices. So it's just good I would go to my HR department and say, hey, we looked at modernizing our 401k because it's rare now to have so few choices. And I'm not attacking your employer. I'm sure they're a wonderful place to work. So let's get to our last question. And this one is from Blue Badger 3223. One of my daughters was a Badger from Wisconsin, so this is a Blue Badger. And we had a conversation last week about real estate starting to slow down. And Blue Badger says they recalled the last housing crash. No one's calling it a crash here, just a slowdown. And it appeared to them that all the tech talk coming about a crash actually caused people to stop buying and selling. Kevin, can perception cause reality in the housing market and even in the stock market? Like, what comes first, the talk or the action?
I wouldn't say that perception would cause reality, but it certainly can trigger it. But if you look back to the the subprime era back in the early 2000s and leading into the great global financial crisis. The problem there was people were lying on loan applications, and then they were levering up, putting zero down, buying houses and apartments on speculation, and it was leverage. Leverage is debt, and so anytime there's a problem, a small problem becomes a big problem when there's debt, and so right now, you look at the consumer and pretty healthy. They're pretty healthy, and you look at the real estate market. If anything, a lot of these people they're locked into these mortgages from 5, 6, 7, 10 years ago, and their mortgage rates are probably half of where they are right now. And so, I honestly think if anything, this part of the slowdown is lack of supply because people don't want to sell and because they don't want a different mortgage in this environment. And the other half could be demand softening certainly in some markets, but to think that it's going to be anything close to what we saw in 2008 and 9, I just don't see that.
The circumstances are just, that was a really, at least in my lifetime, once in a lifetime situation. I will share, Chris, I always say to people in liquid markets, today's price is simply a reflection of the collective universe's view of the future. That's true in stock prices. It's true of home prices. Like whatever your home sells for is whatever the marketplace has determined is the future value of this house compared to what you're charging or would like to receive today. It's really true with stocks. So perception, if everyone's global perception is that tariffs are going to create a recession, it does lead to lower prices. But then when it doesn't happen and people start to become more optimistic, even though nothing needed to change, stocks do swing wildly on people's cumulated perception. And I would just, again, suggest that it matters in home prices and stock prices how people generally feel. But to go back to one of my favorite quotes from Buffett, never ever follow the crowd because the crowd's actions and thoughts are reflected in today's prices. So, Chris, just to wrap and put a bow on this question, what is the role of perception versus reality? And does perception create the reality? And does it last? Does it matter if that perception bubble bursts?
Yeah, I mean, I think in a lot of instances it does matter. Perception is like we've seen in the past when markets go down, consumers spend less. I mean, there's a perception that my stocks are down and I can't afford to make certain purchases. So, and same thing with house prices. If house prices start to go down, then people start to spend less. So it does ripple through the economy in certain situations. I don't think it in this situation you're talking about, there's a perception of reality. I think in certain markets there oversupply and other markets there isn't. So generally, I would say times there are, but other times there aren't.
So, Kevin, let's shift to next week. Obviously, the big, beautiful bill. Senate is, I think, sent something today to Congress. I'm not sure anyone knows how it's reconciled and changed some of the facts, but obviously, Elon Musk is not a fan. President wants this done by July 4th. That leaves just a few weeks here. What do you think happens in the next week with the budget conversation? And is it good or bad for stocks?
At this point, my feeling would be that the budget might be baked in already. So whether it passes or not, when it passes, it's going to be something similar to where it is right now, probably with even more packed into it. So, honestly, I don't know that it's going to have a huge impact on stocks next week. The CBO did have a study out this week. It showed that the bill adds 2.4 trillion to debt in the next 10 years. There's some flaws in that data. I mean, they have a really low GDP growth assumption going into it, something like 1.2%. They don't have the Doge cuts in there. They don't have tariffs in there. Both of those could add revenue. But then on the other side of the coin, they're assuming some sunsetting of tax cuts. So I think that estimate is probably not going to prove very accurate anyway. So I think the market at this point is done talking about it and is kind of looking through it.
So it'll be a nothing burger, but lots of screaming and shouting. It sounds
A lot
like,
of
in your
screaming.
view. Okay, and then we've got a lot of economic data. Kevin, Chris, either of you think about, I think we've got CPI coming out, which is obviously the inflation report for consumers. There's the purchasing price index as well, which is inflation for producers. And then I think we've got retail manufacturing and then consumer sentiment that comes out this week. Any thoughts? Do you think it's interesting, like bad news is bad news now when it comes to losing jobs, and good news is good news, which I think everyone's priced in that the Fed's probably not stepping in for the foreseeable future. So does it matter? Does it have an impact? What do you think we see next week on the economic front?
I could jump in. So, I mean, I think by far the big number next week is CPI. It's Consumer Price Index. It's the most widely followed measure of inflation. Last week we got the April number for the PCE, which is another inflation measure. It's one that the Fed really likes, and it was lower, and it was signaling a downtrend in inflation, which was good to see. So next week we get the May CPI number, so the first number, or the first more recent number reflecting just last month. And we'll see if it continues that narrative. And, if it does, then look, it does, it kind of opens that door a little bit more potentially for the Fed to cut sooner. I mean, I agree with you, Joe. We're not expecting rate cuts anytime soon, but that inflation number continues to come down, and you start to see some of the economic data, like the hard data that we saw this week, you start to see things continue to weaken, then it does. It furthers the case the Fed to throw another cut or two in there. I mean, Europe just cut again this week. They're down at 2%. Was it this morning or yesterday?
And it's been helping stocks over there, of course, because they're further ahead and they're getting the economy rolling again. I will just add again with inflation in particular, this May report will be the first tariffs were in place. And if it actually is muted, that will actually be quite, I think, encouraging for the market. If we see a spike, I think that could be quite bad news. So the inflation data has not moved the market a lot, but this one is one that I think is definitely worth keeping an eye out. Chris, anything you'd add to the conversation around the economy?
Yeah, I would think that the CPI would be the main area, but I also think that the tariff talk will dominate the market next week.
I see the president and the premier of China had a constructive conversation. Obviously, that is the needle mover for everyone. Things have been a little bit more sharp elbowed the last few weeks. It's been less kumbaya. Hopefully they bring it back into everyone's going to get this done kind of thing. But I think you're right. The China situation, the tariffs there, I think matters as well.
Yeah, I think that's the big market mover next week would be any kind of positive movement in tariff talks, not only with China but with Japan and other of our in Europe as well. We need to solidify these to get the market, to get the uncertainty out of the market. Obviously, markets hate uncertainty, and until we get these tariff talks moved on, I don't think we can move much higher.
All right. Well, thank you both very much. Hopefully, folks, you found this interesting. We're thrilled to have Terry back. And we look forward to giving you more insights into some of the excitement next week. If you would like to have your portfolio reviewed, please just go to wealthion.com/free. And the team at Grimes and Company, this amazing team of investment folks, will do an analysis of your portfolio, give you a sense of what you should be considering or making some assessments of the internal fees and costs, etc., so that you can make sure that your portfolio is built right for this environment. And we thank you very much for listening. If you have questions and comments, they're really useful for us. They help us create content that's interesting to you. So please subscribe. Be welcome. You're welcome to send us questions. Kevin, thank you very much. Chris, have a great upcoming weekend.
Thanks, Joe.
Thank you, everyone.